Yo, what is up, party people? It is your boy Nico. Welcome back to the Small Axe Podcast. Today, we're going to talk about something that just might ruffle some feathers out there, but who cares? I'm not here to fluff things. I'm not here to sugarcoat this business. I'm here to make it and make it make. I'm here to make it make sense because here's the truth. Too many people are overcomplicating real estate deals today. They dress them up with all kinds of shiny terms and tricky waterfalls. They confuse people, sometimes on purpose, unfortunately. And if you're new to this game, you might think that that's just how it's done, but not over here, not in my world. So today, I'm going to break down exactly how I structure my deals for the most part, why I do it this way, what it means for my investors, and why I believe clarity and simplicity actually win in the long run. Let's get into it. Let me just start by saying this: no fancy waterfalls, no hidden fees. If that line doesn't already make your ears perk up, it should, because the way most syndicators are structured and operating today, there's often a lot of gray area in how and when the general partners or the GPs get paid. You'll hear people talk about IRR hurdles, multiple catch ups, waterfall structures, multiple tiers of profit splits, depending on who knows what. It sounds smart. It sounds like they've got this thing figured out. But let me tell you from experience, what it really does is it creates confusion, distrust, and misalignment. When an investor comes into my deal, I don't want them scratching their head, wondering when and how they're going to get paid, when I'm going to get paid, how I get paid, who gets paid first, what types of splits are there if they meet X amount of threshold. It's kind of ridiculous. It's too confusing. If it's confusing for me as a general partner, it's more than likely confusing for you as a limited partner as well. And yes, I'm talking to limited partners for this part, but I'm also speaking directly to general partners who structure their deals a little bit ridiculously. Don't do it, in my opinion. I understand the idea of a waterfall structure. I understand the idea of hitting certain metrics. If you hit 10%, we should go to 70-30. If you hit 12%, it should be 50-50, et cetera. I get it. And the GPs should be compensated and they should be paid. But you know what? We should really just be focusing on operations and getting the deal to operate and perform excellently. That's our goal as GPs. Yeah, we want to get paid, but you know what? Just get the deal done, make it work, make it a good deal, operate it strongly, and everybody wins. That's my thesis. That's my goal. That's how I operate. And I sure don't want to be looking at a 5 tab Excel monster with macros just to figure out what I will get in the end, figuring out which cells mean what cells reference what part, what formulas are using what, who's getting paid what. If we have a potential refi, just stop it. Skip all that nonsense. Here is what I do: simple, clear, and clean. I usually set a preferred return between 5 and 8%. That's based on cash, not IRR. So if you invest $100,000 and we have a 7% preferred return, that means you're expecting to get $7,000 per year before I even see a dime. That's how it's supposed to work. And here's the kicker: if I don't hit that preferred return in any given year, it accrues. That just means I owe it to you the next year. It doesn't disappear. So if I don't pay any money in year one, using the same example, I owe you $14,000 at the end of year two if you invested $100,000 at a 7% preferred return. And I'm not making money. If you're not making money, I'm not making money. And to say it more clearly, if you're not beating that benchmark, that threshold of the preferred return, then I don't get paid. I don't get to participate in any of the cash flow. So during the time of operations, I am not touching a single dollar of profit. And that's how aligned we are. I make sure that my investors eat first, always. After we meet that preferred return, then we split the rest. And even that is clear from and even that is clear from day one. The only thing that I get up front is an acquisition fee. Sometimes. Do I get the entire acquisition fee? Never. I split it with my team. The only other fee that I get is an asset management fee, and I've never actually collected it because I like to push all profits to the LPs. However, I will be collecting asset management fees moving forward. And if you know anything about asset management fees, it's literally just to keep the business going, keep it afloat. It is maybe buying coffee every day. It is not enough to survive off of. It is not taking much from your profit. Now, back to basics. Sorry, 7% preferred return, $100,000 invested, $7,000 a year. If you don't get 7,000, I don't get a dollar. If you get $7,001, I get to participate in 30% of that $1. So you get $7,000 and 70 cents. I get 30 cents. And I have to split that 30 cents with my entire GP team. So I'm not even getting 30 cents. The point is this: you get paid first. Yes, sometimes it's a 70-30 split. Sometimes it's a 60-40, maybe even a 50-50, but I will be upfront and honest with you from the get go. So you're not confused or wondering what the split is going to be after we meet that 5 to 8% preferred return threshold. 70% or the higher number typically goes to the LP investors where the capital is invested and where I invest my capital as well. But whatever the split is, it's laid out in the PPM. It's clear from day one. There are no surprises, no games. So I keep it very simple. I keep it like this: you get a preferred return, 5 to 8%. If I don't hit that, I don't get paid any of the distributable cash flow. After that, we do a split, and it is a split thereafter. There are no weird waterfalls. 7% preferred return. Then I get to participate in 30% of the profits above that. So you're still getting 70% of the profit. Excellent, in my opinion. This is the best, most clearest, most concise, and simple way to do it for you, my beautiful LP loving people. Why do I keep it this simple? Why not use some sort of complex IRR waterfalls or promote catch up tranches or whatever people are calling them these days or whatever people are looking to do? Because in all honesty, this game isn't about impressing people with vocabulary and complex scenarios of waterfall structures. It's about building trust. It's about building a relationship that will last forever. I hope to build a relationship that lasts multiple years or even generations to where your kids will want to invest with me in the future as well. I believe that simplicity builds trust. When my investors know exactly what they're getting into and when, I believe that that really matters. When they know that I don't get paid until they do, and then even after that, I'm only getting a small portion of the profits and they're still participating in the profits, that matters even more to me. It makes the conversation a lot easier. It makes them more likely to reinvest. It makes referrals happen. And let's be honest, it helps me sleep at night knowing that everything is above board and aligned with my investors. Now, here's the part that people always don't want to hear. A lot of operators overcomplicate things on purpose. Yeah, I said it. People do this on purpose. They want to blur the lines between who's getting paid what and when. They build in hidden fees, weird splits, asset management overrides, all kinds of stuff that are hard to track unless you are a spreadsheet genius and really diving into what everybody has underwritten and their spreadsheets. You need to be a ninja. And I've seen it. You've probably seen it too. And it's not cool. Look, I get it. The business takes time. The business takes work. It takes risk. It's hard on my end as a general partner. Sometimes you don't get paid for years. So when the money does come in, it's tempting to pad that structure a little to make up for all of the work that you've done, all of the stuff that you've put in for years of hard work and labor. I get it. I'm not judging anybody here, but I'm telling you this: that's not how I operate. Because for me, the long term reputation, the long term relationship is more valuable than the short term dollar. I'd rather take a smaller piece of a clean, honest deal than a larger slice of something that feels shady, icky, and just not right. So here's the big idea I want you to walk away with today. You don't have to do what everyone else is doing. You don't need to complicate things. You don't need complicated structures to build credibility and show that you know what you're talking about. You need clarity. You need honesty. You need to respect your investors and treat their capital like it is your own, like it is your little baby. And that's the kind of operator that I strive to be. And honestly, that's the kind of operator I look for when I am looking to invest my money as well, when I am looking to partner with people, when I am looking for somebody to refer if I don't have a deal. So when my LP investors are looking to me for a deal and I happen to not have one, I look for an operator that is transparent, open, honest, and keeps things simple and straightforward. No ridiculous waterfalls. Although, yes, I do get them, and sometimes it's important. I kind of just feel, as I've been saying this entire podcast, it's just overcomplicated. It's not necessary. Let's get deals done. Let's get people paid. Let's get people an awesome return, and let's keep the deal flow going. So if you are an investor thinking about working with me, now you know how I roll. And if you're an aspiring investor, I hope that this helps you see that simple doesn't mean unsophisticated. It means real. It means responsible. It means you're building an empire the right way, brick by brick, deal by deal, helping people out get the real feel. We need people out there that are going to be open, honest, transparent, keep things simple. Yeah, you can make it complicated if you want, but it's got to be very clear for the LP investors. So if the LP doesn't get it and you kind of are a little bit shaky on it, then don't do it. Keep a very simple structure. And I think that you'll build trust in the long run with your investors, and your investors will appreciate it. If this episode resonated with you at all, please do me a favor, share it with just one little person who is thinking about investing in real estate, or post it on your social media and tag me in it, Nico Salgado. If you have not found me yet, go find me. I'm on Instagram, Facebook. I'm on TikTok even, but I'm not posting much yet, and I will. I'm also on LinkedIn. I'm not posting much anymore, but I should. You know the deal. I am a busy dude. I have 4 different jobs that I work nonstop, and this is my passion. This is my life. This is my goal, to build an empire that will last me generations and inspire you guys to do the same thing. I may be rebranding myself coming up shortly, but you'll still find me. And you know I love hearing from you guys. So stay sharp, stay honest, and as always, keep building. And I will catch you guys on the next episode. Adios. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.